Welcome, everyone. Another edition of Financial 15, the show where we try to provide some knowledge, something that can improve your finances, and try to wrap all that up in 15 minutes or less. And today we're talking about how to draw down your retirement portfolio. Do you start with the RRSP? Do you start with your LIRA? What if you have a corporate account? It can get a little complex. That's what we're going to tackle today. You're going to want to stick around.
Yes, as we always say, you know what? There's this video. There's a variety of different topics we have. Go to our website at beckeror.com so you can see everything that we've got there. Visit our YouTube channel or like us on Facebook. We are more than happy to try and help out with anything we can in the financial world, and occasionally other odds and ends beyond that. Clint, why don't you start us off?
Yeah, let's dive into it here. So we're going to tackle how to draw down your portfolio in retirement. But before we get to that specific step, we have to take a step back, look at the bigger picture. And when that comes to retirement, we're talking sources of retirement income. Two questions here. Where's the money coming from? And how much do you need? And you can see on the screen there's a couple of big categories. And these are very broad. We could have 10 videos each on each category. But we're just going to zoom in on one of them today. But quickly, the employer pension, I'll mention that one. That's the green box on the screen there. That can be, for example, a group RSP you contribute to at work and your employer matches your contribution. Or maybe you have a strong pension, you have a defined benefit pension plan where there's a guarantee involved, all different sorts of company pensions. But that's what the green box is all about. What's the orange box about there, Kevin?
Yeah, the orange box that we have, of course, is what the government provides you in retirement. And you're allowed basically two different scenarios. There's the CPP. If you've been working in Canada, you are eligible for CPP. That amount can be decided. And there's videos that we have on our website that will do that. The other portion is when you hit 65, if you've been a resident for a while, you will get OAS. So the old age security is another one. These are two provided government pensions to help you going through. And then, of course, that leads us to our third category, which is personal savings, Clint. And that's what we want to talk about today, isn't it?
That's what we're diving into today. We're trying to determine in retirement those personal savings. So that could be your RRSP, could be your TFSA, your non-registered funds. All of that falls into the broad category of personal savings. How do you draw those down in retirement? Now, keep in mind here, you've got all those different sources of income. You have that retirement income you're shooting for. Maybe you need $5,000, $6,000, $3,000, whatever you need every month in retirement to pay the bills. All that has to be contended with before you get to that personal savings category. But now that we're there, broadly speaking, you got three big steps. We order them in terms of tax. So the most heaviest tax, that's where we want to start, the one of the biggest tax liability, and then we kind of work our way down from there. And then one of the biggest tax liabilities, typically your registered accounts, your RSPs, your LIFs, your LIRAs, whole bunch of alphabet soup there. But those are normally the ones with the biggest tax liability, and that's where you want to start drawing down your income in retirement. Do you agree with that, Kevin?
Yeah, I do. I completely agree with that sort of scenario. And again, we mentioned this, it is heavily taxable. These are the ones that you want to draw down first because they're the ones that are going to be listed as pure income. There is no tax advantage for how you draw them down. There's nothing along the lines of capital gains or anything else. We'll get on that later. But yeah, draw your RSPs, your RIFs, your LIRAs, even the corporate accounts down because anything that's heavily taxed, those are the ones you want to take out first. They are the ones that are going to have the most implication for how much you keep at the end of the day. And that's what we're trying to get at. Beyond the taxable, though, then we should start non-registered. What are we talking about with non-registered here, Clint?
Yeah, so broadly speaking, you have your registered accounts, you have your non-registered accounts. You can see TFSA at the bottom there. That's technically a registered account, but it's a special version, lots of tax perks there, so we leave that one in its own category. The non-registered account is if you have money outside of an RSP, for example. You've topped up your TFSA, you've topped up your RSP. That third investment account would be the non-registered account. Think of it as a pay-as-you-go system. Every year, you'll probably have to claim some tax on whatever the growth has been on those investments. So it's not as heavily taxed as a withdrawal from an RSP. It's not as tax efficient as a TFSA. Normally what you see would be capital gains, it'd be dividends, it'd be interest income. Often you get a few tax perks with the non-registered accounts. So that would be number 2 on the list. You'd want to start by getting rid of those RSPs, LIFs, and LIRAs, all those items, and then work your way to the non-registered account. A quick note here, you'll notice on that first line, the most heavily taxed items, we did include corporate accounts. Everyone's going to be a little different. Some people say draw down the corporate account first and then do the RSP second. Some people say it's the other way around. It really does depend on your situation, but just keep in mind those corporate accounts do have some tax liabilities as well, which is why we lump them in with the registered accounts on that first category. So we've talked about number 1 there, Kevin. I just went through number 2. Lead us through number 3. Why is the TFSA last on the list?
Yeah, the tax-free savings account is basically the one that we want to touch last. It's ones that you can still continue to build money into, actually, even in retirement, if you don't need everything taken from the first two. And the rationale is because even though it is technically listed as a registered account, everything in there is tax sheltered, which will become tax-free to you when it's drawn out. Whereas if you go into a registered account, you get a deduction up front, no deduction out the back end. All the money that's going in there is after tax money. So you've already paid on it. It's allowed to grow tax-free as long as you have it in there. And when you haul it out, there is no addition to your income. So that is why we recommend this portion to come last, because basically if you wanted an extra $10,000 or $15,000, you haul it out of your tax-free savings account. None of that applies to your income for the year, and the government doesn't get to touch any of it. So based on that sort of a scenario and the way that it's sheltered, we would recommend these would be the last funds drawn. And whether it's for your normal purpose, dealing with everyday household scenarios, or whether you're looking at it for something special like a vacation or a purchase, that's where I'd go. After those three, but the way it's drawn, again, the next one that we're going to have to take a look at is taxes. And what you pulled up here, Clint, is our tax scenario for Manitoba. Why don't you take us through this?
I'll walk us through the details here. Keep in mind, this is the Manitoba federal and provincial combined. So if you don't live in Manitoba, this wouldn't really apply to you. However, there's a free website, taxtips.ca. You can see the full URL on the bottom of the screen there. You can go there and they have all of it listed. Simply pick your province, pick your territory, and you'll get a very similar tax table that applies to your location. We're using the Manitoba ones. That's where we live. And the question we're trying to answer is we now know the order of how to tackle those personal investments in retirement. Start with the heavier, more tax items, then the non-registered, leave the TFSA for last. But how much do we take? Do you just take all of it out in a lump sum? Do you take big chunks, small chunks? There has to be some kind of barometer. That's where the tax brackets come in. So if you add up all of your income, for example, let's say you get some pension income and other sources of income, and it puts you, say, at $50,000. Well, you want to take out at least what you need. That's always the starting point. But then beyond that, try to fill up your tax bracket using those registered accounts, using those heavily taxed items. That way you won't pay any additional tax, but you're getting the money out of the heaviest tax items first, leaving your TFSA and your non-registered account to cover some of the extras. Does that make some sense, Kevin?
Yeah, I think that's a perfect definition of what we want to take a look at. And again, we did mention, try to maximize the tax zone if you can. So you might not need the cash, but as you mentioned, I mean, if we're sitting there at, say, $65,000 that we've earned, I mean, we could basically take it up to 72 before we hit the next tax bracket. If we don't need that cash, we can take it out. We can put it in a non-registered or maybe into our TFSA where we won't have to pay tax on it later down the road, but we're getting it out before we'd have to increase numbers that we've got. So yeah, basically your heaviest tax stuff first. And these are the sort of goals that we want to look at. Now, as we mentioned, each person's an individual. So how you draw it down is going to apply to you, but there are different scenarios going on. And we may have to worry about OAS or whether or not we're making too much money, but I agree. Those are some of the scenarios we should look at. Is there anything else on the tax side that we really need to consider?
No, I think we covered some of the basics there. It can get more complicated if you have a spouse, if you're doing some income splitting. There's a whole lot more that can go into it, but that's the basic building blocks of how to tackle that question. How do you start drawing down your portfolio in retirement? Those would be some of the tips to start with. You look at your total income, you look at what your needs are, and then you go through that rubric. The first, starting with the heaviest tax items, then into the non-registered accounts, keeping the TFSA for last, and how to determine the amount to take out. Well, first, make sure your needs are satisfied. You get enough to have some fun, and then after that, try to fill up your tax bracket. So everyone's situation is different. Everyone's a little unique, but that's a general guiding principle, if you will, that you could apply to your situation and try to save a little bit of tax in retirement.
Yeah, I agree with that completely. And again, we mentioned this on the personal savings. Again, government has something, your company may have a private plan. Those are separate topics that we've dealt with beforehand, and you can see them on our website on any of the videos we've had beforehand. So if you want more information on anything in particular that we've talked about here, or how to plan your retirement and how to draw down, please visit us below, as Clint said, with chat with Clinton and Kevin, and we're more than happy to answer those. I'm going to leave you for the final closing comments here, Clint. Do you have anything else you want to add?
Yeah, you can visit that webpage. There's a contact form there. Simply fill in your information, and we're happy to help out, happy to answer any questions. No shenanigans here. It's simply a conversation, so please reach out. We'd be happy to tackle your question. With that, we'll say, everyone take care, stay safe. We'll be back again soon with another video.